Read this headline from Fortune magazine. The Fed is starting to worry about the housing market now. Our central bank, the Federal Reserve Bank, just released a report where they said that they now have concerns about the housing market. Minutes from the central bank's last meeting revealed concern among some policymakers about the housing market. What are they worried about exactly? Home prices falling and what that could mean for the economy. But that's not all according to Fortune. Fresh data also pointed to more worrying signs, especially in new homes. And that's why in this video, I want to explain why the Fed is concerned about the housing market and what they might be doing about it and what you can do to prepare, that we have a better understanding of what might be coming. Let me read you one sentence to explain why the Federal Reserve Bank is concerned. A few participants, meaning Federal Reserve Bank officials, noted a weakening in housing demand with increased availability of homes for sale and falling house prices. Less people buying houses, more people selling houses, leading to price cuts, which is good if you want to buy a house, but not so good if you own a house. But the reason why the Federal Reserve Bank is saying this now is because back in June, we broke a record for the number of home sale cancellations. Why? Well, we don't exactly know. But for one reason or the other, a lot of home buyers in June decided to cancel their contracts. And then we just got new data saying that in July, we broke June's record as 1 in 7 home purchases were canceled. So we have less people buying houses partially due to these home cancellations. We have more people listing their houses for sale on the market, and these things together are causing home prices to fall. Now, I do want to make sure that this is clear. Real estate is very local, and what you're experiencing might not be the average. I mean, if one person makes $10,000 a year and somebody else makes $100,000 a year, the average is $55,000 a year, which doesn't depict what the $10,000 person is making or the $100,000 person is making. There are some real estate markets that are struggling and other real estate markets are still holding out strong. Take a look at this from Realtor.com. 33 out of 50 major cities in the United States are seeing home prices fall. That's cities like Austin, Texas, and Miami, Florida, but the other 17 are still seeing home prices rise in places like Michigan and Ohio. So let me show you what all this means in practicality and what the Federal Reserve Bank is planning to do. Now, I want to remind you, for those of you that are investors or want to become investors, I put together a free investing masterclass where I'll show you how my team and I research investment opportunities to find potential investments before they hit the headlines. It's a completely free masterclass. There's a ton of value in there, and if you want to watch it, all you have to do is register, and I have the link for you down in the description below. And when you sign up for the masterclass, you'll also get market briefs as a bonus. But in 2020, if you wanted to buy this house, it might have costed you $400,000. Now, if you put 20% down, that would be $80,000 in cash you would have needed back in 2020, and you could qualify for probably a 3% mortgage. Some people were getting a little bit less, but let's assume you got a 3% mortgage. That meant that your monthly mortgage payment on this house would have been $1,350 a month. Well, by 2025, home prices had gone up by around 50% according to the data. So that exact same house in 2025 is now going to cost you $588,000. That's an increase of $188,000. And now if you want to put 20% down, it's not $80,000, you need $117,000, and you can't get that same 3% mortgage today. It's going to be around 7% for that mortgage, which means your monthly mortgage payment on this house is no longer going to be $1,350. It's going to be around $3,100 a month, and that's just the mortgage. Your property taxes are also going to be more expensive because this house is almost 50% more expensive, more valuable. Your insurance is also getting more expensive because you're insuring a more expensive house. That's why homeownership has become so much more unaffordable, because not only do you need more dollars, but you have to pay a lot more interest to borrow those dollars. And this is where the Federal Reserve Bank and the government want to make housing more affordable, but there are only 3 ways that housing can actually become more affordable. It can become more affordable if the prices of the houses go down. It could become more affordable if the mortgage rates go down, or it could be more affordable if you make more money. Now, you making more money is kind of outside the scope of the housing market, so I'm not going to talk about that for the purposes of this video. But if you want to make housing more affordable, that means either houses have to become cheaper or mortgages have to become cheaper. But both of these come with consequences. If home prices were to fall by just 10%, that would mean that this house now costs about $530,000. still a whole lot higher than where we were in 2020. Not a huge drop from 2025, but that would mean that about 3% of homeowners in America today would now be underwater on their houses. Yeah, it's slightly more affordable, but you can start to see how that could create a problem. If housing prices fell by 20%, that means now this house is not going to cost $588,000, it might cost $470,000. Still, that's about 20% higher than where we were back in 2020, but if housing prices fell by 20% now, 10 to 12% of America that are homeowners now would be underwater. To put that in perspective, if housing prices fell by 20% and 10 to 12% of American homeowners are underwater, that means 5 to 6 million Americans would be underwater on their houses. You can compare that to 2008 when we had the great financial crisis and around 11 million Americans were underwater on their houses then. So yes, if housing prices fell, it would make housing more affordable, but it comes with the consequence, which is economic pain. On the flip side, if mortgages become cheaper, that could also make housing more affordable. But that also has a consequence. Let's assume housing prices stay the same, and if mortgage rates now fall from 7% down to, let's call it 5%, and you buy this house with the mortgage, now, yes, your mortgage is going to become cheaper. Instead of paying $3,100 a month, you're going to be paying around $2,525 a month, which means you're going to be saving almost $600 every single month on this house just because you got a cheaper mortgage, and this is only going to benefit you if you buy this house with debt. If you buy this house all cash, then a cheaper mortgage doesn't matter, but there's a big if here. This depends on housing prices staying the same or housing prices falling. If home prices go up, well then this might actually make a house more expensive because you could potentially have to pay more dollars to buy the same house, because if mortgage rates were to fall, well, there's a chance that more buyers would say, housing is more affordable. Let me take advantage of this more affordable housing market and the cheaper mortgage rates, and now more buyers enter the housing market. And if more buyers enter the housing market and start buying houses, that could create more bidding wars, and that could push housing prices up. And now if housing prices go up because you have a cheaper mortgage, now housing doesn't actually get more affordable, housing just becomes more expensive, and you need more dollars that you have to finance. This is the big conundrum that our central bank, the Federal Reserve Bank, is trying to solve. And the concern that they're worried about right now is if home prices are falling, which it seems like there are in neighborhoods around the country, that could create more economic pain. And so to protect the United States economy against the economic pain, we've been hearing more and more signals that the Federal Reserve Bank is going to start lowering interest rates sometime in 2025. Couple that with the fact that President Trump has been saying he wants to see lower interest rates aggressively and has made it very clear he's going to replace the chairman of the Federal Reserve Bank in 2026 with somebody who is going to be more aggressive in cutting interest rates. So it seems like we could see lower interest rates in 2025 and potentially even lower interest rates in 2026, which could lead to lower mortgage rates coming in the next 12 months. Now, just so we're on the same page, when I say interest rates, I'm not talking about your mortgage rate. The interest rate that our central bank, the Federal Reserve Bank, sets is called the federal funds rate. That's the interest rate that banks pay one another when they borrow money, and then banks will then mark that up and then sell it to you at the mortgage rate or the car loan rate or the credit card rate. But if the federal funds rate falls, that gives your bank the ability to charge you ultimately a lower interest rate on your mortgage. So if the Fed cut interest rates, it gives the banks more breathing room to lower your mortgage rate, which is why realtors, mortgage bankers, and a lot of people are anticipating lower mortgage rates over the next 12 months. But this is where you want to pay attention to this conundrum, because from an economic perspective, falling house prices is bad because people will be underwater. It means less debts. It means more people are going to default. It could create more problems. But to help solve this problem, that's where now we have the government and the Federal Reserve Bank that want to lower mortgage rates to make housing more affordable. However, yes, you can make housing more affordable if mortgage rates fall, but that only works if housing prices don't actually go up. If housing prices go up, now the affordability problem can now become a unique situation because housing prices are going up, where now, yes, you got a lower mortgage rate, but you also have to borrow more dollars in order to finance that house. This is where one of the things I like to say, if you're buying a house for you to live in, make sure you can afford it. Period. If you want to buy a house, don't try to time the housing market, because housing markets go up and down. We've seen this happen time and time again. And so instead of trying to time the housing market, treat your house like an expense. Treat it like a shirt. Treat it like a liability. buy a house that you can afford. Make sure you have money for the down payment. Make sure you can comfortably afford the mortgage payment. Make sure you can comfortably afford the move-in costs. That's hiring the movers, hiring the furniture people, hiring whatever you need to do in renovations in the house. Make sure you can comfortably afford those things. If you can, go out and buy your dream house when you can afford it. If you can't afford it, rent until you can afford it. If you try to time the housing market, well, you could get sucked into buying a bigger house than you can afford, or buying a house when you can't afford it. And now, instead of investing your money and actually building your wealth, all of your money is going to your mortgage payment, which is front-loaded, which means your banks are making a lot of money in interest for the first 10 to 15 years on that mortgage payment. So, if you want to buy a house, don't try to time the market. Be smart and understand the numbers and understand what's going on and buy a house when you can afford it. And again, for those of you that are investors, you can check out my investing masterclass. I have that link for you down in the description. Now, I know there's a lot of content on the internet about creating passive income, but 98% of what you see is garbage. If you want to have enough income coming from your investments to fund your lifestyle, it is not going to be easy and it's not risk-free. Investing has risks, but it is possible. So now, if you're still sticking with me, let me show you how you can actually do it.